Good afternoon, everybody. I think we have the best panel of the afternoon. That's why Dominique is here. The first talk of the afternoon was maybe a little bit depressing, and definitely the challenges of raising money in the diagnostic space are maybe greater than any of the other verticals here today. So we're very fortunate to have a panel with a wealth of information, both from the entrepreneur and the funder perspective here today. So I'd just like to take, we're going to go over kind of the what, when, and hows of fundraising in the diagnostic space. So I'd like each of our panel members to introduce yourself and your experience in fundraising in the diagnostic space. And then as a first question, how have you seen fundraising evolve, and how is it different than maybe 5 or 10 years ago in diagnostics? Zen, do you want to start?
Okay. Well, I probably have the least to say here because we're only beginning to fundraise for a diagnostics company, next-gen sequencing software company coming out of Harvard Medical School. So it's really too early to tell. But, I think it's an interesting time because in this case, all of the intelligence and the noise and the big challenge is just the amount of data coming off of these machines and the fact that you can have one test to rule them all. If you can actually extract meaning from that noise is the opportunity and the challenge. And so, but a lot of folks are racing for it, and next-gen sequencing is highly hyped, and so there are lots of folks chasing that. So it's always tougher than you think to raise money, especially the first fund. And my background has been in medical devices more traditionally, but then more and more software. So that's kind of the pattern. And then what we're doing at MIT with hacking medicine is kind of all of a piece of that theme.
Okay. Hi, everyone. My name is Jill Carroll. I'm with SR1, which is the corporate VC arm of the pharmaceutical company GlaxoSmithKline, based here in San Francisco. So my personal background actually is a little bit heavier on therapeutics. So I'm relatively new to diagnostics investing, although we did just out of SR1 make a diagnostics investment this year. And SR1, as the corporate VC arm of GSK, has a strong interest in diagnostics investing. I'd say one of the things that we're attracted to about investing in the diagnostics area is the relatively smaller amount of capital that's required to move these companies forward. It allows us to balance our portfolio in a way where we have very capital-intensive therapeutics companies. We can have some companies that require maybe a little bit less capital in the diagnostics area. That said, I think that the area that maybe we can talk about today and that we're quite concerned about has to do with reimbursement. So I think that just given the amount of time that it can take, even with a really exciting and important diagnostic, to get to an actual commercial outcome is something that we think quite a lot about when we're looking at new diagnostics investments. So in general, we're quite interested in areas that we view as very important areas of unmet need in diagnostics, and we're spending quite a bit of time thinking about them. Autism, these type of diseases, which right now are not well diagnosed, are areas that we're looking to see kind of what's happening from an innovation point of view. So I think that's about it for the moment.
Hi, I'm also delighted to be here and very grateful for the invitation. Yes, the world of funding has changed dramatically while I've been in the industry, but so has our way of thinking about markets and what the world that needs healthcare is. And so I have in the past, I'm still in academia, I've run a public company, I'm a totally hardened serial entrepreneur, and I'm now running a non-profit that wholly owns its own for-profit. So I think it's a very original business model. I'm proud to say I'm wildly enthusiastic about the opportunities at the moment. I don't share any of the despair and desperation that we've heard because I don't rely on venture capitalists at all. And I'd be happy to tell you about our model, which has allowed us to raise at least as much money as I've been able to raise through venture capital in the past, in previous companies. And I'm also an angel investor with a group that only invests in women-run and women-funded companies. So I've seen the world from the side of academia as an investor, but I'm actually a management person, and I don't think there's anything to despair about. You can raise money and you can do good now.
So I'm Risa Stack. I'm with Kleiner Perkins, and it's one of the evil venture capital firms. If you didn't hear that from the last talk, we're pretty evil and we won't fund seed and stars, which I think is interesting because it's not true. We do a lot of investing in diagnostics. We have invested in 8 different diagnostic companies. We are still investors in 7. One is Genomic Health, which is a public company, and the market cap usually over $1 billion these days. And I would actually argue that it's easier to fund diagnostics than some of the other business models right now, medtech and therapeutics, because there's questions about reimbursement, but there's questions about reimbursement, at least from my perspective, across our portfolio. It's just where the healthcare system is there's a lot more focus on reimbursement issues, and there seems to be diagnostics are different and new. They haven't, at least the CLIA lab model, which we've been investing in for the last, 8 or 10 years now, is something that a lot of VCs have not invested in, more traditionally in medtech and therapeutics. So, and the other aspect of diagnostics too is, if you look there's been a massive amount of M&A. I mean, probably about the last 10 weeks now, you have DACO getting bought by Agilent, and you have, what's the other transaction? You probably know it. I'm trying to think of it.
Claris being bought by Opco.
Yeah, that's one. There's actually like 2 or 3 more. So there's a lot of M&A in the field. And the other thing that I keep hearing from the companies that want to be in diagnostics, especially the ones with next generation sequencing platforms, Life and Illumina, is they're actively, quote, looking for content, which means they're trying to, figure out what their model is. So, and that a lot of the interest, and I think the kind of the promise of next-gen sequencing is also increasing interest in diagnostics as well. So there's a lot of things that are going on that makes this segment more attractive relative to other segments. So.
Thank you. Tito?
So my name is Tito Serafini. I'm a founder and CEO of a new company, Atreca. And Dominique put me on the panel. The company is not diagnostics per se, but instead is a platform technology play, which might be more of an anathema to current investors in diagnostics you might have heard about. But I'm here to say that unless you don't have the stomach for it, you shouldn't be in the room. That we've been successful, but we've been successful via non-traditional routes. And one of the things I think that, and perhaps we can talk about this more, is that there used to be a feeling that build it and they will come, That doesn't apply anymore. The investors sitting next to me here have built a lot of baseball stadiums and nobody's come to play. And so I think the message that I got, and so I've been working on this incarnation of Atreca for the last year and a half and actively fundraising since probably just after Labor Day last year, and we're just about to close on some financing. So it takes a while, and we can talk perhaps more privately about what personally you need to have on board to weather something like that. But in terms of the idea, and just cut me off, please, if I continue to talk, I think you need something transformative. If it's incremental, forget about it. It's not worth it. It's probably not worth their while to invest in incremental technologies. They want transformative technologies, and your customers want transformational technologies, because the first thing you have to do is find a customer before you can find a venture investor. In fact, we will not be having a venture investor as our first investor because we found some customers who are willing to help launch the company. And I think that's perhaps more and more of what I've been seeing, what I've been hearing from potential venture investors, as well as from colleagues out there who are entrepreneurs. So that's something to keep in mind as well.
Yeah, so I would agree with that, Tito, is that if you can show a customer or a corporate partner kind of that someone that wants to have a business relationship with you, the VCs are much more interested, because as you said, there's been a lot of build it and they will come, and they haven't come. They haven't come for a long time.
So, Risa and Tito, let me jump off of that and ask, at the very beginning of the entrepreneur's journey to raise money, when is the right time to do it? What milestones should they accomplish before they're attractive to capital? Anybody?
I actually think that the entrepreneurs should answer first. The ones who've done it before.
So we could go through a long list, and again, my experience, my previous company and this company have been more platform oriented. I'm also a former academic who's seen the light and come over to the entrepreneurial side of things. In terms of, so let's put it this way. I think that today, and I don't want to speak to my fellow panelists who are really in the thick of it, but from what I've seen as the outside is that, and perhaps I apologize, I missed the morning session, that there's a great deal of turmoil in the investment community, therefore as much de-risking as possible is what is necessary. And therefore, as many boxes as you can reasonably check is what you have to do. And that goes all the way from IP, and I'm on the IP panel tomorrow morning to talk about this, to the team, to getting a customer, to having you don't need a detailed business plan. No seriously sophisticated investor wants a 12-page business plan, okay? What they want is a clear plan with people who've done it before. I will say that I think it's very difficult for a first-time entrepreneur in this environment to stand up and say, in biotech, I'd like to run the show. There are, to be not so cynical about it, but realistic about it, there are a lot of former heads of business development and ex-CEOs and the ex-portfolio companies of these folks that are looking for their next opportunity. This is not like tech where college dropouts get the support of venture and then they bring in adult supervision to help support them. I've seen that happen actually in biotech a little bit, but I think if you're an academic, it's fine because no one's expecting you to leave your day job, and in some cases the venture groups will form their own teams around your idea. But if you're an entrepreneur who's out there trying to commercialize something from a university, I think if you're a first-time entrepreneur, I think you have to have more realistic expectations, and therefore having a team in place becomes important. Having somebody who might be your CEO becomes very important, or at least being open to having that discussion.
I'll just add one comment, is that I agree with pretty much everything he said. I would say that number one, so as you said, check as many boxes as you can. I think the number one thing for us, given times are pretty difficult in terms of building companies, is to work with people you trust. And so a lot of the CEOs of our companies now are former CEOs of companies. We have one situation where a company has come in to see us maybe 2 or 3 times. It's interesting technology, but we're trying to figure out what to do with it. And then a former CEO of one of our companies who sold the company and made us like 7 times our money in 3 or 4 years, which is unheard of right now, came in with that company he'd found. He said, I think this is a really great platform, and here's what I'm going to do with it. And we'll likely invest in that company now because we've got someone who we know has built businesses for us. It wasn't that the technology wasn't good. It was just, it's really hard to build a business, and there are people who've done it 2 or 3 times, and those are the gems that you want to back, or people that you trust, because a lot of our companies are, going through 2 to 3 business models before they land on the right one. And given how constrained we are in cash, you need to be able to work with people who understand that, okay, let's stop. We got to take a right turn now, and let's talk about why. So I'd say, just to emphasize what Tito said, the management is the biggest thing for us right now, is really trusting the people that you work with, because I guarantee you that things are going to go wrong, and they're going to go wrong a couple times before they go right.
Anybody else?
I'm sure you'd like more disagreement up here, but unfortunately, I agree. I think the really important things in getting funding are having a completely disruptive, or at least transformative, technology, but then you've got to show that it really works, and it'll work in the field and with point of care. And again, because I have been around a long time, I'm obviously going to say this, but I think experience does count. And honestly, if you've made money for people before, they're going to come back and try to give you more of it. But it also means that you built good teams before, and you can call on former colleagues to come back, and they want to work. You know, you either got along or you partied years ago. So I really think that it's important to build those bonds with people you work with, people who fund you, and it'll repay dividends in the future. But if you don't write a 6-page business model, have a very good concept of how you're going to be successful, and pick a technology that's stunning, you know, that's really different.
Any other milestones other than already be successful?
Yeah, it's tough. I mean, I think that, you know, not to sort of pile on, but our strategy is very much the same when it comes to this area. If I think of our handful of diagnostics investments from SR1's case, they really are, in most cases, backing teams. So I would agree with what's been said already. I mean, I think that, you know, if we want to just sort of add things to the list, you know, for us, we really do want to have some early data at the very least. So in this area, we're unlikely to invest in things prior to having had some, you know, data proving out the concept. And then, you know, we really like to see a clear use of proceeds and a team that kind of has a vision for raising the right amount of capital at this stage to get to kind of the right inflection point. I think that that's an important component of sort of any pitch to the venture community, but it's something that if we're going to sort of add on, what do we want to see? I think that's an important element.
Yeah, I think, you know, I've kind of specialized and we're creating a new class at MIT called Disruptive Healthcare Innovation. I think the challenge in the early stage is it's just a world of possibilities, you know, and especially at the kitchen stage table, where you think that your technology can work so many different ways. And I guess when I partner with the technologists, I end up trying to map to the value and the volume, and then the best array of kind of reduced decelerants to a particular clinical indication. So, you know, you're looking at where do you have the lowest barriers for regulatory and reimbursement, and where do you have the highest pain, and it's just kind of that pattern recognition that you try to do. And I guess, you know, one of the challenges with working with experienced entrepreneurs is sometimes they're biased towards one particular venture before, and it's in medicine it's so easy to get specialized down a particular, you know, clinical domain. So you just have to be aware of that and choose who you want to listen to.
Tito?
I was just going to add, though, that I don't want to make it seem as if you need to have your 15 boxes checked before you ever talk to anybody, because one of the boxes for me personally is getting some early feedback from somebody you trust who is actually in the investor community. And so this is probably, you know, there's a whole session one can have about strategy, how one approaches a fundraising round, and who to talk to first and second and third, and how to structure it, and what timing and all that sort of stuff. But I do think, and this is one of the reasons that experienced folks can be useful as part of the team, is they will have those connections. And sometimes you have a diagnostics play that you're trying to pitch, and if you know somebody who doesn't invest in diagnostics but invests in an allied space like therapeutics, and you just want some feedback because they have colleagues who invest in diagnostics, they know the space, they've sat around the table with their partners and heard the diagnostic pitches, they'll be able to give you some useful feedback without you necessarily tarnishing your story by, you know, falling on your face in front of your, you know, second or third choice, you know, let alone your first choice investors. So there are a lot of boxes to check, yet at the same time I would include one of those boxes is talking to smart people who have the opportunity to provide you some feedback early in the process.
I think that I'd just add one thing, which is we've been talking a little bit maybe about more mature investments to a certain extent. So one thing that SR1 has been thinking about is how to kind of help fill the gap at very early stage investing. There was a lot of discussion about this at the last panel in terms of different ways to access early stage capital. And so, we've been having quite a bit of dialogue about the general flight to later stage investing that we've seen in some of the venture community, and have actually started and set aside a small fund to do some early stage, what we're calling incubation work. So this might be pre-Series A work to try to find and identify the talent who might be the folks who are going to make us 7 times our money several times over in the future, and ally with those people earlier in their careers. So I think there are, to the point that others have made, kind of different pots of capital to go after at different points in the life cycle of a technology and a company. And I think that some different folks from different parts of the community, whether it's pharma VCs or other kind of folks who are going after real early stage investing, are trying to identify the right investing models to marry up with those business models early on.
So it's great that you're setting money aside, and we saw from the earlier talk that there are lots of opportunities growing for early stage entrepreneurs. How, as an entrepreneur, do you decide which funding sources you're going to go after, whether you're going after strategic partnerships or venture capital? What do you weigh to make that decision, and what kinds of questions do you ask these partners to make sure they're as good for your team as your co-founders?
Entrepreneurs want to take that one
I'll
first.
start. So,
Yeah.
so I'll be very honest in the effort to actually, help you learn through my experience. When we started, I did not realize that the environment had changed so very much that the only way to obtain traditional venture backing for a platform company was to already have a customer with a term sheet. And that was not what, I was expecting, especially because I had checked so many boxes. I had a team full of, business person had spent 20 years in the industry, people who could do strategy and finance, research, had so team was fine, proof of concept data was amazing, technology was transformative, it wasn't good enough. But that taught me that, I had to go find that customer. And what's fascinating is once I got traction with customers, then several venture groups bellied up to the bar very quickly and started to, make noise about moving forward and so forth. But at that point, unfortunately, or fortunately, depending on what side you're on, the customers were willing to step up to the plate themselves, and so we didn't need to go the venture route. So at least now, I'm sure we will in the future. So from my, that would be my experience drawn, is that the feedback was very, very useful early on in the fundraising to help understand what the atmosphere was. And it's not that I lacked for friends who were venture capitalists who I bounced the idea off before I started on the fundraising. No, I absolutely did that. But even perhaps they didn't quite appreciate the degree to which things had changed as a whole.
I'm one of those people who always thinks all of the above is the right answer. So Diagnostics for All now has 3 sources of funding. Grants, things like the Gates Foundation, DARPA, DFID, USAID, the NIH if you want it. We also have funding from wealthy and charitable donors. We're a 501c3. And because our technology was designed specifically to make diagnostics for the developing world, it's extremely inexpensive, point of care. We'll talk later about how to avoid CLIA. But if you think about that, who doesn't need cheaper healthcare? So we found that our technology is also extremely valuable as a platform to for-profit companies. So I joined 2 and a bit years ago, and we've raised money in addition from corporate partners. So by licensing our very substantial Harvard portfolio. And I don't want to allow any of our for-profit company, the shares of which are wholly owned by the non-profit, to be owned, 51% by VCs at the moment. I will eventually sell a small minority position in the for-profit when we have raised the valuation. so that we can bring in more money and give away less of the company. And I think we're getting close to that point now. But you heard in the previous session, and you probably heard, I'm afraid I wasn't here this morning either, that investors like to come in when there's a lot of non-dilutive funding in there already. So we have somewhere between 10 and 15 million, maybe even a little more, of grant money and donation money in the non-profit at the moment. So that's, I think, very attractive because there's that base there when VCs or we may never go to those kinds of investors when other investors come in. So what you want to do is have a very disruptive technology, prove it works, and then begin to threaten the industry a bit. So, you know, I found that speaking to clinical diagnostic societies tends to get a very agitated audience, and they start to wonder about this very inexpensive stuff. I have to show it to you. I'm just so proud of these things. You know, we have these little things the size of postage stamps that diagnose basically by any diagnostic technology. And this isn't a chip that fits into a machine. This is the entire device. And it costs cents, usually under 5 cents. If we put the electronics on board, maybe 10 cents or more. But I love, there was a comment from Dolly Parton that says it costs a lot of money to look this cheap. And I mean, this is sophisticated technology. So we have a lot of patents, and it takes a lot of money for us to develop one of these very cheap tests. So we do need investment money and grant money up front. But my advice is take it any way it's attractive to investors and make sure your business model will work off whatever that model is.
I would tend to agree. So prior to sitting in this chair, I spent 10 years on the operating side. So I'll speak from my sort of entrepreneur and operating side background here. But it was very much an all of the above strategy in pretty much every company that I've worked in, whether it was on the investor side or on the company side. I mean, that said, it's kind of hard to bootstrap through grants and that sort of thing because they can be relatively small potatoes, right? So
they're better than VCs at the moment.
Oh no, except SR1 and Kleiner.
Oh, of course.
Right? Yeah. So, but anyway, I think I just tend to agree that it's nice to have a parallel processing track because, even to the points that have been made already, you know, we don't know kind of what's going to materialize, especially for a very early stage company, in terms of really getting that interest and people willing to kind of back the company and put some money in. So I think a parallel processing between angels, people, you know, VCs who are going early, grants, foundations, is going to the extent that there's bandwidth to manage it within the management team, is going to probably increase the likelihood of success.
I think it's important to point out that while Una has had such a fantastic expertise, you know, the co-founder of the technologies, George Whitesides, has been a serial entrepreneur academic who really had a very clear vision for, you know, driving down the cost of diagnostics and, you know, and leveraging something very cheap, and then how do we do that? And so, you know, that vision from the very beginning of the use case and, you know, and the cost of goods was there from the beginning. And I was lucky to have scientific co-founders from this is the company that I spun out in 2002, which was kind of the nuclear winter of venture funding. And I was leaving under one of the Bain Capital founders, and they're quite a large venture fund. And so I got to learn from a master, but then went out to jump across the other side of the table. And you know, I was a young punk, but I was very lucky to have my old boss backing me. And so then I searched for something early and ugly to co-found, and found some fantastic scientists. And you know, but it was a year and a half process, really, working for free, figuring out who to partner with, and then once I found that group and that technology, you know, what was the best positioning for it, and that's the hardest work, because there is so much ambiguity, and you know, and it was a peptide gel scaffold, you know, a biomaterial, and what's it good for? Is it going to be drug delivery? Is it in vivo tissue engineering? Is it, or is it only in vitro, cell culture use? So we kind of arrayed all of that, and I had the additional challenge of my founders really wanted it to get used widely. And so, the traditional pattern of taking something, keeping your data very private, not sharing it with anyone, was not really a priority for my co-founders, and they really wanted to create a research reagent and put it out there. And I had to figure out a strategy that matched that mission while we still drove, value for a high-end clinical indication. So that was what you wrestle with. But luckily, I had the trust, being a 30-year-old, of folks I'd worked with. So
I think it'd be interesting to see the different points of view between the investment and the entrepreneur community in, once you secure funding, what is your anticipation of an exit? Can we have the entrepreneurs go first?
You guys always have to go first.
You want to start on?
So if one does have a for-profit company, one establishes it to provide a return to investors, and that's what I view my job as, even if I don't have a venture investor. So, but the type of exit might be less constrained by a timeline that might accrue if, depending upon a venture investor and where they are in their fund when they make the investment into your company. I think, though, to the degree that one can resource from non-traditional types of funding, and this, just hearing what Una said sort of jogged in my mind. Something to add to that is, I think whatever you're proposing, make sure you investigate it very hard for nonprofit use, be that via a research tool in the academy and academia, or foundations. There are many foundations that are hunting for technologies to help their cause. And so it falls into the all above category, but I do think that these days one has to not be focused necessarily on the for-profit end of what you're selling, but make sure that in order to get funded to reach that goal, one has the ability to sell into a nonprofit market, and that what you're doing is appealing to those who are nonprofits. And with the right mix, I'm sure we'll hear from Una, she never needs an exit as a nonprofit.
No, but we have exit strategies.
But you have exit strategies. But so I think your exit strategy, quite frankly, will be driven by your investors. And your job, at least my job, is to see to it that they get a return.
Well, that's a nice segue, actually, for me. We did it backwards. We have the non-profit as the original founding company, and that is what licensed the technology from Harvard exclusively. So the IP is with Diagnostics for All, the 501c3. We have already got this wholly owned subsidiary, the stock of which is owned by Diagnostics for All, called Paper Diagnostics, which allows us to do our partnerships and even sell diagnostics to big pharmas and other big companies. But if you think about these kind of platform technologies, ours was initially thought of for human health. So it tests people's blood, urine, sweat, tears, those kinds of things. But it's become very clear to us that there are agricultural uses, environmental uses, food safety uses. So I think it gives us the possibility to spin out a number of other subsidiaries, which we will not be able to fully resource and take all the way through to product. Currently, we work with big partners, but I think the sensible and probably profitable way to exit some of the technology with value to investors is through those kinds of spin-off opportunities. So we're sort of actively engaged in a number of different relationships there. So I think there will be opportunity for investors to make money, while I will now keep my soul pure by staying with the nonprofit.
Jill, do you want to, as when you were an entrepreneur,
I was thinking of it from the investor side for this one.
In a second.
Yeah, I think that I think it's actually probably the same answer, which is I think we have to be mindful of an exit strategy for everywhere that we invest all the time, and I think it's really important for the entrepreneurs and the investors to have a very transparent discussion about where we realistically think value is going to be created and at what sort of return you can sort of hope for that to be. So for us, we're not necessarily pursuing, I'm switching to the investor side, can't help it, not necessarily pursuing a strategy where we need to put all the money in right now that's going to take us to an exit, but we want to have around the table a syndicate of investors who tend to agree with us about how much money it's likely to take and where that value inflection point is going to be created, and the management team who's incented and really excited to work toward those outcomes. So we're highly mindful of exit strategy, I think like all investors and all entrepreneurs and everything that we do. And of course, we're limited because there's such a mediocre IPO market now to really thinking about combinations of companies and M&A type exits. So entrepreneur or investor, I think it's one of the most critical components of this to have a path toward thinking of how we're going to exit our investments.
So I guess I'll maybe give the controversial answer. I agree with Tito. Everybody has to think about making money, whether you've got angel investors, and obviously you're not working 12 hours a day, 6 to 7 days a week just to see what happens. You want to make a lot of money as well. I would say the bar is probably higher for a lot of the venture capitalists because, so let's take Reg's example that he gave in the talk right before us, is that $1 million went in, they sold for $25 million. That's a phenomenal return. For angel investors, I mean, that's great. I mean, those almost never come along, so that's phenomenal. I'd say what most venture capitalists now, and maybe this is part of the challenge of what's going on in terms of from seed investing to later stage investing, and I'm actually seeing this change on the tech side, but what I'd say is most of the venture capitalists have raised such big funds, so you have to put together, $10 to $20 million per work in a company, and so if you're looking to put that much money to work, you have to have a really big idea that you believe can be worth, can go public or can be worth, hundreds of millions of dollars easily. And I think whereas if you've got an angel financing and you've got a really nice, interesting business, I mean, my partners would look at me and said, wow, that's a great return, Risa. $1 million and you've returned 25, but how many times we have a $500 million fund? You can't do that 500 times. So I think that's some of the challenges as a venture capitalist investor. So you're wanting the bigger exits, whereas maybe if you just have a round of angel financing or smaller round, and the example that Reg gave again, if Tito owned 10 or 15% of that company, is say he was the CEO and did that for 2 or 3 years, I think you'd be quite happy, and so I think that's the difference. I think this has become even more acute now because it's really hard to get companies public, and you used to be able to get companies public and then exit them. It's really hard to get pretty much any life sciences company public right now, and when you get them public, they're financing events. So what really happens when they go public, and we've got a couple of these in our portfolio, 30 to 50% of the money is actually from insiders. And it's just another financing event. Now at least you have a liquid security that you can then choose to exit, but you're going to raise more money in the public market to continue to get to the point of exit. So the challenges are IRRs are going down substantially, and I think Alan spoke to that. But so while I'm a venture capitalist, I think, depending on what your goals are, if you can accomplish a lot of money on $1 million, geez, do it. Do those exits all day in terms of an exit. So I think that's what you need to think about. And I think there are a lot of potentially business opportunities which, from a venture capitalist perspective, might be, quote, niche opportunities, but you can make a nice business of them. I mean, you can either have a great technology that's just developed enough that somebody needs it, or you can generate a company that has, let's say $10 million of revenue or $15 million of revenue, and you only put $1 million into it. That's a good business. I'm not necessarily saying a venture capitalist will invest in it, but it's a really good business. So I think that's, you have to see what your goals are and understand what you'd like to achieve. So
I think especially with early stage businesses, it's so hard to kind of see around the corners, and things change, and really you're trying to generate the data as fast as possible in order to validate or invalidate, and you really have to just be a good experimentalist. And the key in terms of fundraising and thinking about exits is matching the expectations of people with the right spirit and mission that are on your board and on the management team, so that you can adapt. And I think just as a concrete example, our little company out of MIT, we eventually raised a total of 1.7 million from angels. And then within 18 months, we had got to break even because we didn't try to scale the company too fast. And we did a worldwide licensing deal with Becton Dickinson for the research product. And we really got that out, and that got us to break even. And then we really had a lot of flexibility with kind of how we grew the business and what pressures were on us. And while we had all these academics writing papers using our stuff in stem cell biology and primary cell culture and cancer research. And so then, fast forward 4 years after a bunch of preclinical studies and partnering with J&J and Medtronic and Boston Scientific in order to have them pay for us generating large animal studies, so that really with the strategy of them seeing the data, right, and trusting the data that we generated because they engaged the academics that and paid for it on our behalf, while being smart about not parsing our IP and really keeping that all under our control. And that really gave us option value and data that they believed in going forward. And then, based on that, we actually raised a bunch of money non-dilutively, or most of it non-dilutively, outside of the U.S. And that was enough to fund the first human clinical study, on which we went public with a, $150 million valuation that's kind of doubled after the IPO. So, that was like, okay, 1.7 million really took us all the way, and it was blood, sweat, and tears for 9 years, but it was a very different way to grow. And, if we had done that, raising 40 million up front, and then we would have pissed a lot of it away.
Let me pose a hypothetical. Let us strip you of all experience and accomplishment that you've had to date. You are a young entrepreneur starting your very first venture, and you have a brilliant idea, and maybe you have a great team, and you need capital. What are 3 things that you would do walking out of this room to find funding sources for your company? Zen, why don't we start with you?
Yeah. Get the scientists out of the building and talk to customers. That's the most important thing. Talk to people who will use it, who will buy it now.
I mean, the first thing that popped into my head is that I would call the 3 smartest people that I know in this particular area and kind of flesh out whatever details there are around the business model. I think when it comes to finding money to go into the new venture, I would definitely want to find some money that came with some expertise. So I'd be very interested in bringing in some folks that could really help shape the company and mentor it as it grows.
I think I would say that you want to work on something that really matters to the world. I don't think it matters what the problem is, but it needs to be a big problem. I'm much more interested in the really big problems of the world than hair growth in males or something like that. But and then care about it and let it show as you speak to investors. And then I think the other thing, and I always say this to women founders and startup entrepreneurs, is never, never give up. I think it comes from a Winston Churchill saying, you fight them in the trenches, you fight them in the hedgerows, but you never, never give in. And people will turn you down. Just keep fighting.
So I guess I actually thought when I was going to say something else, but my initial thought came off something that she said, which was that find the transformative application. I mean, because right now, as a venture capitalist, there are a lot of interesting opportunities, but they have to be, I want something that's really different, is the big idea, is really going to change something. Go after a really big problem and use your technology in a transformative way to do it, because just having a little bit better this or that isn't that exciting. So for example, there was in the drug development world, there was a state, I'd say about 7 or 8, 9 years ago, there was a lot of interest in drugs that were maybe a little bit better or a little bit different than the existing ones on the market. And right now, given where reimbursement is, it's got to be very, very differentiated. So whatever you're trying to do, make sure it's a big problem and you have a transformative solution.
So perhaps, your question was, what's, if you're, wet behind the ears and new and eager, what's the first thing? You wanted 3, but that's tough. But let's start with 1 as you walk out the door. The first thing is, and maybe it's too late and maybe it's not, is choose your founders carefully. Okay? And I'm thinking more of academic founders here. I'm not talking about the team you might assemble around yourselves. And actually, they're founders too if they're working without pay and believing in you. And we can get into the whole how you share equity. I think there's a whole session on that sort of thing. But I'm talking about academic founders now. Academic founders who have started other companies and been successful are a resource you cannot buy, you cannot trade for. You should get on your knees and walk to their lab doors and beg them to be a part of your endeavor. And that means that perhaps your idea is coming from the assistant professor, and your job is to convince the assistant professor, who nobody knows but who's brilliant, that what you need as part of this is the senior guy down the hall who's done this a lot, who's in the same field, who can help make those connections with potential customers, potential investors, other people who can help join your team. It's an ecosystem. It takes a village. You by yourself, wet behind the ears, going out there and trying to make things happen, that's the really hard way to go.
So let me just add on that, because that's a really great point, and I'm so glad you brought it up, because so it's like even at UCSF, the venture capitalists have their connections. They know the guys like Frank McCormick founded Onyx, a whole bunch of other companies. They're the person that Frank will call them, or we call Frank. There's the kind of people just like the people in the business community have been there, done that. There's a network of those people, and if you're working with the assistant professor and you just even get Frank McCormick, as an advisor on the board, because then he's talking to, me or my partner Brooke Bars, it's this really cool technology or company I'm involved in. So I think that's really leverage that network, because, you may not, as, as somebody who, you might not get much of, that senior guy's time, but if you get a little bit of his time, at least it's top of mind when he's talking to somebody who could be your business partner, who could be your investor, or he's talking to the guy who was a former CEO of Onyx or something like that. He's kind of, you're on his mind, and he may refer people to his network, through his network. So.
Okay. I'd like to thank the panel for your time and your thoughts. It was very informative. We have to let the folks from the hotel go to catch their bus, but thank you so much. Please help me thank the panel.